Welcome! All right, let's talk capital gains. If you're a professional in this field, you know that the entire calculation, everything, really hinges on one single word: cost. The new Income Tax Act of 2025 has done us a huge favor by consolidating the definition of cost into one crucial place, Section 90. So today, we're going to break it down piece by piece. Let's get right into it.
Okay, so picture this. It's a classic scenario. You've got a property bought for 50 lakhs and it's sold years later for 2 crores. The taxable gain is just 1.5 crore, right? Simple subtraction. Well, you'd think so. But when it comes to tax, the answer is almost never that easy. The real calculation is way more nuanced, and trust me, getting it right is everything.
So how do you get to the real taxable amount? It all comes down to correctly calculating what the law considers your cost. And this is where the new Income Tax Act of 2025 is a real game changer. It tidies everything up by putting all the rules that defined cost into one single consolidated section, Section 90.
So here's our game plan for today. We'll kick things off with the basics, why cost is so fundamental. Then we'll dive deep into its 2 main components, the cost of improvement and the cost of acquisition. We'll also navigate some special cases that you'll definitely encounter, and then we'll wrap it all up with a practical example to make it all click.
So why are we obsessing over this one little word, cost? It's simple, really. Cost is the absolute foundation of your entire capital gains calculation. If you get the cost wrong, the whole thing is flawed and your tax liability will be incorrect. It's as fundamental as that. Let's look at the basic math here, which comes from Section 72. Your capital gain is the total sale price you get minus 3 key things: any direct expenses on the transfer, the cost of acquiring the asset, and the cost of improving it. Our focus today, Section 90, is what gives us the precise legal definition for those last 2 critical costs. All right, let's start building this out. We'll tackle the first piece of our cost puzzle, the cost of improvement, as defined in Section 90, subsection 1. So what can you actually deduct here? The law is very specific. A cost of improvement has to be a capital expenditure that adds to or alters an asset. So think of it this way. Adding a whole new floor to a building? Absolutely, that counts. But giving the house a routine paint job? Nope, that doesn't. The change has to be substantial and actually enhance the asset's value, not just maintain it.
Now, this is a super important point, so pay close attention. There's a critical cutoff date, April 1st, 2001. If you acquired your asset before this date, you can only claim improvement costs that you incurred on or after this date. Anything before is ignored. This was brought in to create a clear, modern baseline for tax calculations. For any assets acquired after this date, it's simple. All your capital improvements are eligible.
The law also tells us what is not a cost of improvement. For self-generated things like goodwill, the cost is taken as nil. And this is a big one. You can't double dip. If you've already claimed an expense as a deduction against your property or business income, you can't then turn around and add it to your cost of improvement when you sell. Okay, on to the other major piece of the puzzle, the cost of acquisition. Now, this area is a bit more detailed, and it's covered pretty extensively, from subsections 3 all the way to 8 of Section 90. There are some important nuances here. Now, for all you seasoned professionals watching, these principles will probably feel very familiar. They're based on Section 55 of the old 1961 Act. The core logic hasn't really changed. The big win with the 2025 Act is that it brings everything together into one much more readable section. It just makes compliance clearer and a lot more straightforward. But cost of acquisition isn't always just the straightforward purchase price. The law has very specific rules for different scenarios, and it's absolutely essential to know them. Let's look at some of the most common ones. You've really got to know these rules inside out. For self-generated goodwill, the cost is NIL. Simple. Same thing for bonus shares you receive for free, cost is NIL. For rights shares, however, your cost is the actual amount you paid to buy them. And if you're an existing shareholder and you renounce your right to buy those shares, the cost of that right is also considered NIL. Okay, now for a big one, something that affects pretty much every stock market investor. Section 97 has what's called a grandfathering clause. This applies to listed equity shares you bought before February 1st, 2018. It was specifically designed to protect the gains that were earned before the long-term capital gains tax was reintroduced for these shares. Let's walk through this step by step, nice and slow. First, you take your actual purchase price. Second, find the fair market value, or FMV, of the share as on January 31st, 2018. Third, you have your final sale price.
Now for step 4, you compare the FMV and the sale price, and you take whichever is lower. And finally, for step 5, your cost of acquisition is the higher of your original purchase price and that value you got in step 4. It's a bit of a dance, but this formula makes sure you're only taxed on gains made after the law changed. Okay, that's enough theory. Let's see how all these rules actually work in the real world with an example. And after that, we'll talk about the key compliance points you absolutely need to remember. So let's imagine this scenario. We have a house bought way back in 2005 for 20 lakhs. It sold in 2026 for 1.5 crores. And along the way, in 2015, a new floor was added for 10 lakhs. So how on earth do we calculate the taxable gain here? Now, because this is a long-term asset, we don't just use the old price. We have to account for inflation. This is called indexation, and it's a huge benefit. The idea is to tax you on your real gain, not a gain that's just been inflated over time. So we use the government's Cost Inflation Index, or CII, to adjust both the acquisition and the improvement costs to their approximate present-day value. So after we run the numbers and apply indexation to both the purchase price and the improvement cost, the illustrative taxable gain in our scenario comes to 95 lakh rupees. Just think about that. That's a massive reduction from the simple profit of 1.2 crores. It just powerfully shows you how critical these calculations are.
To make any of these claims, your documentation has to be perfect. That's non-negotiable. You must keep all the purchase deeds, transfer documents, and every single bill for improvements. Some common mistakes we see all the time are people trying to claim minor repairs as capital improvements, using the wrong CII year, or getting that multi-step grandfathering rule for shares wrong. Meticulous record keeping is truly your best defense.
Phew, we've covered a lot of ground, so let's distill all of this down into the key takeaways from our deep dive into Section 90.
So if there are 5 things you take away from this explainer, let them be these. 1. Section 90 is your new one-stop shop for all cost definitions. 2. That April 1st, 2001 cutoff for improvement costs is critical. 3. Always be aware of the specific cost rules for things like bonus and rights shares. 4. Master that grandfathering rule for your pre-2018 equity investments. And 5. Document everything meticulously. So the question to leave you with is, with this clarity, how can you better strategize for your future capital transactions?
And that wraps up our explainer on Section 90. We really hope this has brought some clarity to what can be a very complex topic. If you found it valuable, please do us a favor and like, subscribe, and share this with your network.
This explainer is for educational purposes only and does not constitute professional advice. Tax laws are subject to change, so please consult a professional advisor before taking any action. This is an AI-generated educational video.